With the stock market in a fritz, diversifying your investment portfolio is a wise move. And adding dividend ETFs to the mix can provide that diversity and stability. In this video, I'm going to cover 5 ETFs that you should consider. And I'm going to evaluate them in terms of dividend yield, historical performance, holdings, risk level, and expense ratio. Let's begin with the Vanguard High Dividend Yield Index ETF, or VYM. This ETF provides exposure to dividend-paying large-cap companies that exhibit value characteristics in the US equity market. At the time of this video, the fund consisted of approximately 440 companies in the consumer, energy, and industrial sector, and contains some well-known names like ExxonMobil, Pfizer, Pepsi, and Walmart. This ETF has a 5-year return of 23.1%. This means that if you invested $10,000 5 years ago, it would have grown to just over $12,300 today. That's on top of the dividend yield of 3.15%. Now you might be thinking 3.15% is not that impressive. I've got stocks in my portfolio paying north of 7 to 8%. But be aware of the dividend trap, which is when companies dangle the carrot of high dividend yield to attract or maintain investors. A prime example is Intel, which until recently paid dividends of 36.5 cents a share, or a yield of 5.52%. From the outside, this is a healthy dividend yield, but this is also misleading because the stock has taken a beating over the past year due to fierce competition from Apple, AMD, and TSMC. This is an example of a dividend trap where the yield is unsustainable. You would expect Intel to redirect resources to R&D and other growth initiatives to remain competitive rather than paying out dividends. As predicted, Intel announced in February that it was cutting its quarterly dividend by 66% to just 12.5 cents a share. This, combined with a decline in the stock price, has pushed the dividend yield down to 1.85%. With that said, let's talk about the expense ratio and risk level for this ETF. With an expense ratio of 0.06%, this is one of the cheapest ETFs to own. You can expect to pay $6 for every $10,000 invested. With regards to risk, on a scale of 1 to 5, with 1 being low risk and 5 being high risk, Vanguard rates this ETF at a 4. This is because the fund has a moderate risk beta of 0.86, which means that its performance is moderately correlated to the overall stock market's performance. You can think of beta like drive modes in your car. A beta of 0.5 is like eco mode. When you press the gas pedal, the car is slow to speed up, but it also keeps you safe. A beta of 1 or higher is like sport mode. When you press the gas pedal, the car just wants to take off. On the flip side, you can also find yourself on the side of the road in a ditch. Using this analogy, while the stock market dropped by 10% this past year, the fund saw its price drop by only 4.77%. And this price drop may not be a negative if you are a prospective buyer, because as long as the underlying companies maintain their dividend payout, a lower ETF price actually increases the dividend yield. If you're not clear on what dividend yield means and how that translates to money in your pocket, I'll explain the math later in the video. This ETF has a track record of declaring and paying out quarterly dividends with a dividend payout ratio of approximately 40%, which is in the healthy range. The payout ratio is the percentage of a company's earnings paid out as dividends. You want to avoid payout ratios greater than 50% because the company is probably trying to lure new investors at the expense of long-term growth. So who is this ETF for? It's a good choice for buy and hold investors looking for long-term investments, especially given its focus on value stocks, moderate risk profile, low expense ratio, and an established track record of paying out dividends. Next on the list is the Vanguard Dividend Appreciation ETF, or VIG. Contrasting with VYM, this ETF offers exposure to dividend-paying large-cap companies that exhibit a blend of value and growth characteristics within the US equity market. With the portfolio consisting of approximately 300 companies, the exposure is tilted heavily towards consumer staples, healthcare, and industrial sector. Companies are considered for inclusion into the fund based on their history of increasing dividends, and only companies that have increased their payouts for at least 10 consecutive years are included. The fund contains recognizable names like MasterCard, Visa, Microsoft, and Coca-Cola. The fund has a 5-year return of 45.53%. This means that if you invested $10,000 5 years ago, it would have grown to just over $14,500 today. On top of that, the dividend yield is around 2%, which is paid quarterly. And the payout ratio for this fund is just north of 37%, which is desirable. Similar to VYM, this fund has an expense ratio of 0.06%. And on the risk front, it has the same beta of 0.86, which gets it a 4 rating from Vanguard. So if the market goes up, the fund follows. And if the market tumbles like it has this past year, so does the fund, which had a 1-year return of negative 4.27%. So who is this ETF for? In my view, this fund is a good complement to VYM as you get exposure to both value and growth stocks by owning both funds. Also, this fund only invests in companies that will continue to pay out dividends in the future, making it a solid pick if you are focused on dividends, even if the diversification is a little lacking. And third on the list is the S&P 500 High Dividend Low Volatility ETF, or SPHD. As the name suggests, this fund tracks an index that tries to pick those S&P 500 stocks that provide the highest dividends with the least turbulence within the US equity market. Accordingly, the portfolio holdings are heavy on utility stocks and light on fast-growing tech companies. Some of the companies that make up the top 15 portfolio holdings are household names like 3M, AT&T, Verizon, and Walgreens. The fund is on the pricey side with an expense ratio of 0.3%, and it makes up for this cost with a dividend yield of 4.16% and a payout ratio of 47.8%. And income investors will appreciate that the dividend is paid out monthly. On the risk front, this fund receives a 3 rating from Morningstar due to its focus on low volatility stocks. As such, this fund is not weighed down in a bear market, but it also remains understated in a bull market. Over a 5-year period, the fund has appreciated 4.76%. So if you invested $10,000 5 years ago, it would be worth just under $10,500 today. This fund is definitely not beating any of your growth stocks in the S&P 500 by a long stretch, but it doesn't need to. It's serving the purpose of being a low volatile dividend ETF, which is to provide stable capital returns and higher income returns through dividends. Fourth on the list is the Global X Super Dividend US ETF, or DIV. This fund tracks an equally weighted index of 50 high dividend, low volatility stocks in the US equity market. In its portfolio is a list of companies that you will probably not recognize, but are stable and low volatile in nature. The fund is on the expensive side with an expense ratio of 0.45%. For passive investments like ETFs, an expense ratio of 0.5% or greater would be considered expensive. In the case of this fund, the high expense ratio is more than made up for with the dividend yield of 7.18%. The payout ratio is just shy of 85%, which is slight cause for concern, but this fund has paid every month since inception in 2013. From a risk perspective, this fund has a beta greater than 1, which puts it in the higher risk category. But this also makes it an excellent option if you are looking for a fund to outperform the all-cap value segment of the market. And finally, we have the global variant of DIV, which is aptly called Global X Super Dividend ETF, or SDIV. This fund tracks an equal weighted index of 100 global equities with high dividend yields. Its portfolio contains equities mainly from North America, Brazil, China, and Australia. Similar to DIV, this fund has an expense ratio of 0.58%, which puts it on the high end. But it makes up for it with a dividend yield of 14.39% and a payout ratio of 71.09%. Initially, I was skeptical, but this fund has declared and paid out dividends every month since inception in 2013. From a risk perspective, this fund has a beta of 1.1, which puts it firmly in the high risk category due to its exposure to international markets and only 30% to North America. With a 20% exposure to China and Hong Kong markets, the fund faced headwinds last year due to China's zero COVID policy. But this could also be a tailwind this year as China emerges from these lockdowns. China is one of the few major economies currently easing monetary policy, with its central bank injecting liquidity into domestic markets to stimulate economic activity. This could give the fund a boost going forward. So who is this ETF for? Of the 5 ETFs on this list, this is the only one that provides international exposure. As such, it may have appeal to you as a core holding as part of a long-term buy and hold strategy. Or it could also be useful for establishing a short-term position over a group of equities that offer attractive distributions and a unique risk-return profile. Now, I want to circle back to a point I made earlier in the video on showing the math behind dividend yield and how that translates to money in your pocket. Dividend yield is calculated by taking the dividend paid, dividing by the current price of the stock, and multiplying by 100. This calculation shows that yield is a constantly changing metric because the stock price is constantly changing. However, yield crystallizes the minute you purchase a dividend yielding stock. Post-purchase, the yield will only change if the company paying the dividend changes the dividend amount. If the dividend amount goes up, your yield will follow in the same direction, and vice versa. You don't want to anchor your decision on which ETFs to buy based on dividend yield alone. For example, a high dividend yield of say 14% could actually be a sign that something is not right because most companies aren't setting out to provide a 14% dividend yield as it's unsustainable. So in many cases, a high dividend yield could actually indicate a falling stock price. If you look back at the dividend yield formula, reducing the stock price while holding the dividend amount constant increases the dividend yield. Even if dividends are continuing to be paid out, a massive drop in the price of the underlying stock is not desirable. There are 2 questions to round out this video. Can I live off of dividend income? And if so, what should the size of my dividend yielding portfolio be? To answer these 2 questions, the most important number to determine is your cost of living. Let's say you need $70,000 a year to cover your healthcare, housing, food, vacation, insurance, etc. Assuming an average dividend yield of 4%, the size of the portfolio that you will need can be calculated by taking $70,000 and dividing by 4%, which equates to $1.75 million. Obviously, the cost of your lifestyle and average dividend yield are constantly changing, but this calculation gives you a ballpark to aim for. Even aiming for partway can make a significant positive impact on your life. Say your dividend yielding portfolio is worth $500,000. Assuming an average dividend yield of 4%, you can calculate the amount that you will get by multiplying 4% and $500,000. In this case, that equates to $20,000 per year, or just over $1,600 a month. Think about the bills you can pay using this amount and the reduction in your stress level because you're not entirely reliant on your employment income. And therein lies the value of incorporating dividend ETFs into your portfolio mix. I hope you found this video useful. If you did, please give it a like and subscribe to the channel. I'll see you on the next one.